For years, Ontario was seen as a safe bet for retiree investments and cross-border homebuyers, until the unthinkable happened. 12 once booming markets in Ontario are now collapsing, with home values plunging on up to 35%, rental returns vanishing, and thousands suddenly underwater on their mortgages. What caused these cities, names like Windsor, Peterborough, and Kitchener-Waterloo, to go from hot prospects to cautionary tales almost overnight? Behind the headlines, the data tells a story that every investor needs to hear before making their next move. How did Ontario's so-called safe havens become Canada's new real estate risk zones? The answer may upend everything you thought you knew about this market. Ontario's reputation as a safe haven for retiree wealth and cross-border investment did not come out of nowhere. For years, mid-sized cities across the province were celebrated as affordable alternatives to overheated urban markets, drawing in a steady stream of buyers from both sides of the border. The formula seemed unbreakable: stable Canadian banking, steady population growth, and a housing market that, even in downturns, rarely saw more than a modest dip. In the early days of the pandemic, that confidence turned to outright exuberance. Bidding wars erupted in places like Brantford and Peterborough, where homes that once sat quietly on the market were suddenly fetching offers well above asking. Out-of-town buyers, flush with equity from Toronto or American cities, snapped up properties sight unseen, convinced that Ontario real estate could only go one direction: up. Families and retirees who had watched prices double in the Greater Toronto area saw these smaller cities as their last chance to get in before being priced out for good. The narrative was everywhere. Ontario was immune to the crashes seen elsewhere, a fortress of value in a world of volatility. But that sense of security came with a blind spot. Few questioned whether local economies, built on manufacturing, education, or resource extraction, could actually support the soaring prices. Investors, lured by the promise of quick gains, poured money into pre-construction condos and single-family homes alike, betting that the demand would never dry up. As the frenzy spread, stories circulated of properties changing hands 3-4 times in a single year, each sale notched higher than the last. Real estate agents became local celebrities, and the fear of missing out drove even cautious buyers into the market, convinced that waiting meant losing out forever. It felt unstoppable. Yet underneath the optimism, warning signs were already flashing. Affordability metrics stretched beyond historic norms. Locals found themselves priced out of their own neighborhoods, while rental yields slipped below the cost of ownership. The market's momentum was fueled less by fundamental demand than by the belief that someone else would always be willing to pay more. When interest rates began to climb and remote work trends reversed, the underlying fragility became impossible to ignore. The same factors that had supercharged Ontario's boom, easy money, investor speculation, and a rush of out-of-town buyers, now threatened to unravel years of growth in a matter of months. The myth of Ontario's real estate invincibility was about to face its harshest test yet. Ontario's real estate market is now defined by numbers that leave little room for debate. In June 2025, active residential listings across the province climbed to 78,605, an 18% jump from the year before, and the highest June inventory recorded in over a decade. Sellers are flooding the market at a pace not seen since the aftermath of the 2008 financial crisis. New listings rose 6.4% year over year, pushing supply well beyond what current buyer demand can absorb. The sales to new listings ratio, a key measure of market balance sits at just 38%. This is deep into buyer's market territory. For context, a balanced market typically falls between 40% and 60%. Below that, buyers are in control. In the Greater Toronto Area, the ratio is even lower at 32%, while Hamilton and Mississauga hover near 39% and 29% respectively. These figures signal a decisive power shift. Buyers now have the upper hand, and sellers are increasingly forced to make concessions just to attract an offer. Months of inventory, a measure of how long it would take to sell every home on the market at the current sales pace, has stretched to 4.6 months, up from 4.0 a year ago. This means homes are sitting longer and the backlog is growing. In practical terms, buyers can take their time, shop around, and negotiate aggressively. Sellers, meanwhile, face mounting pressure to reduce prices or risk watching their listings stagnate. The regional breakdown reveals where the pressure is most acute. Central Ontario, which includes the Greater Toronto Area and its surrounding commuter belt, saw average home prices fall by 5.1% year-over-year to $1,112,837, the steepest annual drop of any region in the province. While the provincial average home price is down 3.7% to $852,036, the scale of the correction is even sharper in markets that led the boom. These are the same cities now seeing the fastest inventory growth and the weakest sales-to-listings ratios. Transaction volumes underscore the story. June's 16,961 home sales represent only a 1.1% increase from the previous year, but that figure remains 14% below the 5-year average and 22.3% below the 10-year June average. The dollar volume of sales, $14.5 billion for the month, dropped 2.8% from last year, showing that even modest gains in sales activity can't offset falling prices. Year-to-date, sales are down 13.4% from the first half of 2024, a clear sign that the spring market failed to deliver a rebound. The data points to a structural shift, not a seasonal lull. Inventory is piling up, the pool of active buyers is shrinking, and sellers can no longer count on quick, competitive offers. In the hardest-hit regions, the gap between new listings and successful sales is widening, leaving many owners with little choice but to lower expectations or their asking prices. These numbers set the stage for what's unfolding in individual cities across Ontario, a market where supply far outstrips demand and where the correction is both broad and deep. Hamilton and Windsor stand as reminders that real estate fortunes are never insulated from the industries that shape them. Hamilton, once the heart of Ontario's steel corridor, faces a future clouded by external shocks and mounting fiscal burdens. The city's benchmark home price has fallen nearly 9% in the past year, as investor confidence wavers and buyers grow wary of what lies ahead. Steel tariffs imposed by the United States, 25% on imports, with threats of further escalation, have already put thousands of local jobs at risk. About 10,000 people work directly in Hamilton's steel mills and fabrication plants, with thousands more in supply and service roles. Business surveys show nearly 40% of local firms have shelved investment plans due to trade uncertainty, and a third anticipate workforce reductions if tariffs persist. Compounding these industrial headwinds is the city's escalating infrastructure debt. The Hamilton LRT, once pitched as a $1 billion project, now carries a $3.4 billion price tag, with federal and provincial governments each on the hook for $1.7 billion. The city is left to cover ongoing operating and maintenance costs, even as property taxes climb 12% annually to manage the shortfall. For homeowners, these rising costs come at the worst possible time, when property values are falling and demand is thinning. Listings linger, and price reductions are now the norm rather than the exception. Windsor, meanwhile, has seen its own reversal. The city's housing market soared during the pandemic, buoyed by its role as a cross-border bargain for American buyers and its deep ties to the auto sector. That cross-border advantage has faded fast. Local agents report a 70% drop in US-based buyer inquiries since 2023, as currency swings and Detroit's own housing recovery have erased Windsor's appeal. Home values in Windsor have dropped 14% year over year, with active listings up 65% and homes now sitting on the market for nearly 2 months, more than double the pace of 2022. The city's auto plants, once a source of steady employment, now face layoffs and automation pressures, further sapping local demand. Insurance premiums have jumped 22% amid rising flood risk, and property taxes now run 15% above the provincial average. In both cities, the story is no longer just about real estate cycles. It is about the vulnerability that comes when local economies lean too heavily on a single sector or external demand. As steel and auto fortunes swing with global policy and American consumer trends, the housing markets in Hamilton and Windsor are left exposed, reminding buyers that the real risk isn't just falling prices, but the deeper instability that follows when economic foundations begin to crack. Kitchener-Waterloo was once the poster child for Ontario's tech-driven optimism. The region attracted global attention as a magnet for startups and established firms alike, drawing skilled workers and investors who saw the area as an affordable alternative to Toronto's overheated market. For a time, that reputation seemed unshakable, but the past year has delivered a sharp correction that few anticipated. Over 1,100 tech jobs have disappeared from the local economy. BlackBerry alone eliminated 800 positions, while Shopify's local division shut down, cutting another 300. Even Google scaled back, reducing its office footprint by 40% and shifting key roles to Toronto. The consequences are visible across every segment of the housing market. Office vacancy rates have soared above 15%, a level not seen since the early 2000s. Rental demand, once propped up by an influx of well-paid tech workers, has softened. Landlords who banked on steady appreciation and high rents are now facing longer vacancies and stagnant lease rates. Properties that once drew multiple offers are sitting on the market, and price reductions are becoming routine. The ripple effect extends to the resale market, where listings outpace sales and buyers, wary of further layoffs, are negotiating aggressively. Kingston, long considered a safe bet thanks to its university anchor, is facing its own reckoning. Queen's University enrollment has dropped 8% since 2023, driven by tighter international student visa rules and shifting demographics. That translates to roughly 2,000 fewer students seeking housing, a demand shock that's left hundreds of downtown rental units empty or discounted. Investors who purchased properties at the peak, counting on a steady stream of student tenants, are now grappling with negative cash flow and rising vacancy rates. These setbacks reveal a common thread. Markets that once relied on the promise of endless growth from tech or education are now exposed to the risks of sector-specific downturns. The correction isn't limited to manufacturing towns or resource hubs. Even cities built on modern industries and higher learning are showing signs of overreach, with bubbles deflating as quickly as they inflated. The pain is spreading, and the lesson is clear. No sector, however promising, is immune to the forces reshaping Ontario's real estate landscape. Sudbury, once buoyed by nickel's global demand, now faces a 30% plunge in commodity prices that's rippling through its housing market. Listings are up, buyers are scarce, and homes that changed hands at the peak are now worth tens of thousands less. North Bay, long a regional hub for mining support and government services, is seeing its own slowdown. Younger residents are leaving for bigger cities, and the market's brief rally has faded into caution. The story is similar in Brantford, where manufacturing jobs haven't kept pace with population growth. Properties that once sparked bidding wars now linger, and sellers hoping for a spring revival are instead lowering their sights. Peterborough, fueled by a pandemic influx of remote workers, is grappling with a sharp reversal. Sales volume has surged as prices drop, but affordability remains out of reach for many locals. Rental vacancy sits at just 1%, squeezing both tenants and would-be buyers. In Oshawa, the auto sector's uneven recovery and a spike in unemployment, up to 7.8%, have left the market exposed. The city's role as a commuter hub has lost some of its shine as hybrid work policies shrink demand for long-distance relocations. Barrie, once a magnet for Toronto's remote workforce, is adjusting to a new reality. Sales have dropped nearly 40% year over year, and the return-to-office trend has cooled the appeal of far-flung commutes. Construction and service sector layoffs compound the pressure, while sellers hang on to price expectations rooted in the boom years. Niagara Falls, heavily dependent on tourism, has watched cross-border visitor numbers and hotel occupancy fall. Short-term rental investors are pulling back, and the average sale price has slipped alongside a surge in inventory. Thunder Bay, more insulated than most, is still feeling the strain as resource jobs ebb and new development struggles to keep pace with changing demand. Even here, interest from out-of-town buyers is waning, and affordability is no longer the safety net it once was. Across these 7 cities, a familiar pattern emerges. Price declines in the 20 to 35% range, rising inventory, and a growing disconnect between what sellers want and what buyers can afford. Each market's trigger is unique. Commodity swings in Sudbury, manufacturing in Brantford, tourism in Niagara, remote work reversals in Barrie, but the result is the same. The ripple effect has turned local slowdowns into a province-wide contagion, pushing Ontario's real estate correction from isolated incidents to a systemic recalibration. Investor optimism once fueled Ontario's housing surge, but today, that confidence is unraveling under the weight of higher borrowing costs and tighter lending rules. The Bank of Canada's policy rate, which hovered near zero during the pandemic, has climbed steadily, pushing the mortgage stress test to 6.48%. For many, that hurdle has become insurmountable. Buyers who once relied on easy credit now face rejection, and those who stretched to qualify in 2021 or 2022 are struggling to keep pace with rising payments. The retreat is most visible among multi-property owners. At the height of the boom, investors holding 11 or more properties made up 13% of multi-property transactions. That share has since been sliced nearly in half, falling to just 7.2%. The days of rapid portfolio expansion are over. Instead, seasoned investors are offloading assets, unwilling to weather negative cash flow or risk further price erosion. The result is a sharp drop in investor-driven demand, leaving a vacuum that neither first-time buyers nor end users are eager to fill. Capital is flowing out just as quickly as it once flooded in. Canadians withdrew $83.9 billion from domestic investments over 4 months, seeking safer ground in U.S. equities and other assets. This exodus leaves Ontario's housing market exposed, with fewer buyers to absorb growing inventory. Teranet data confirms the trend. Investor presence is shrinking, and new listings from former landlords are rising across the province. The stress isn't limited to those with large portfolios. Small-scale investors, many of them couples or families who bought a second or third property as a retirement plan, now face higher carrying costs than rental income can cover. With rents leveling off and vacancies rising in some cities, the math no longer works. The demand that once propped up prices has thinned, replaced by caution, and, in some cases, outright retreat. For Ontario's real estate markets, the era of easy investor money is decisively over. Stories of fast profits have given way to a quieter reality for thousands of Ontario households. For those who bought at the peak in 2022, the odds of coming out ahead have shifted dramatically. Teranet data shows that 1 in 4 homes purchased that year and resold in 2024 changed hands at a loss, a rate 6 times higher than the province's historical average. In the Greater Toronto area, the typical loss on these sales reached $56,000, erasing down payments and years of savings in a single transaction. Across Ontario, the median loss still sits at $45,000, with some cottage country sellers seeing losses in the hundreds of thousands. Negative equity is no longer an abstract risk. For many recent buyers, especially younger families who stretched to enter the market, their homes are now worth less than their remaining mortgage. This has left them unable to refinance, move, or even cover closing costs if forced to sell. The pressure is most acute as mortgage renewals loom. More than 1.2 million fixed-rate mortgages in Canada, many originated when rates were below 2%, are set to reset at sharply higher payments through 2025. For a typical Ontario household, this can mean hundreds more each month, on top of property taxes and utilities that have also climbed. The financial strain is beginning to show in the data. TransUnion and Equifax both report Ontario's 90-day mortgage delinquency rate has climbed to 0.24% in the first quarter of 2025, a 71.5% jump from last year, and the highest level since the aftermath of the 2008 crisis. Younger homeowners are especially exposed, with delinquency rates now exceeding pre-pandemic levels for those under 36. For many, the family home, once seen as a foundation for stability, has become a source of mounting anxiety. The consequences ripple outward. Households forced to sell at a loss face years of financial recovery. Those who hang on may find themselves squeezed by rising payments and shrinking options if prices fall further. In today's Ontario market, the risk of being underwater is real, and the path back to solid ground is anything but certain. In June 2025, Ontario's sales to new listings ratio stands at just 38%, with active listings topping 78,605. Clear evidence that supply now overwhelms demand. Across the 12 cities featured, home values have dropped between 20 and 35%. Nearly 1 in 4 properties sold in 2022 did so at a loss, according to Equifax, with the median Greater Toronto Area loss reaching $56,000. Investor ownership of multiple properties has fallen from 13% to 7.2%, and capital outflows now exceed $83.9 billion. These numbers reveal a structural correction, not a short-term dip. Yet it remains unclear when or if these markets will stabilize, as future interest rates and economic recovery timelines are still unknown. What is certain? Ontario's former reputation as a safe haven for retirees and cross-border investors no longer matches the current reality. In today's market, documented risks far outweigh unproven promises. For buyers and investors, caution, grounded in hard evidence, remains the most reliable strategy.